Hi, my name is Sharmila Hana. I'm from Good 6. Today, I will introduce two important companies in Malaysia automotive industry. First one is DRB Highcom Berhad and second one is MBM Resources Berhad. Both have played big roles in growing the industry and supporting Malaysia economy. First one, let's talk about DRB Highcom Berhad. Founded in 1996 through the merger of Highcom and DRB, this company is a large group involved in automotive, aerospace, banking service, and property development. Next is its focus on growing its business by selling non-car assets and finding new ways to earn revenue. Core business of DRB Highcom is first one is automotive, is on Proton, modernize and manage Avis rent car. Next is aerospace and defense, makes aviation parts through CTRM and defense vehicle through the DIF type. This sector is on stake in Post Malaysia, Bank Muamalat, Post Pacom and logistic company. In property, it develops industrial area and primary residential project. DRB Highcom used its expertise in many fields to grow and succeed. Let's talk about MBM Resources Berhad. MBM Resources Berhad, founded in 1980, it started as Malaysia Daihatsu Distribution and has grown into a leading automotive company based in Kuala Lumpur. Core business of MBM Resources is, first one is motor training, sales brand like Daihatsu, Hino, Produa, Volvo and Volkswagen. It offers vehicle maintenance and spare part. Next is automotive parts manufacturing, makes steel wheels, safety system, and NVH noise vibration and harness product for major car manufacturers. MBM Resources is a trusted partner in Malaysia car industry. Why we choose this company? Next, this company for analysis in 2024 because first one is the big impact. They contribute a lot of the industry revenue and market share. Their relevance is they reflect the latest trend and challenge in the automotive world. Next is easy access on their financial data and reports are available for study. Second is direct competitor, complete and similar market industry leader and provide example best practice. Their result affect the whole industry and the company will pick for their leadership performance and to allow fair comparison. In conclusion, DRB Highcom Berhad and MBM Resources Berhad are the key players in Malaysia automotive industry and it known for their expertise and contribution. Now I will pass my part to Bashir to continue their part. Thank you.
Thank you, Hannah. I'm Ahmad Bashir with the ID of 2024324781. We'll continue on my part, which are the ratios used in determining both companies' current performance and past performances based on their actual statements. Through this analysis, we will be able to tell whether the company's financial standing and condition is in good health or otherwise. These analyses are crucial to financial managers for them to uncover trends, strengths, and weaknesses. By doing this analysis, it will enable the managers to take appropriate measures to correct any deficiencies or enhance any strength to ensure the achievement of the firm's goal in maximizing the shareholders' wealth. Here are the ratios used. First, we have the liquidity ratio that measures the firm's ability to pay back their debts on time. Second is profitability ratio. It is used to measure the capability of the firms to turn their assets into profits. Third is leverage ratio. It is used to determine the firm's degree of using borrowed funds. And lastly is activity ratio. It is used to show the effectiveness of the firm's utilization of the assets. Next is liquidity ratio. Okay, what is liquidity ratio? It is used to measure the liquidity or availability of the firm's liquid resources to pay current and maturing liabilities on time. As a basic rule, the higher the ratios are better as they represent higher ability to pay. As we can see from these charts, both the companies show quite a vast difference in terms of their liquidity position. As for the current ratios, DRB Highcom shows a downtrend from 2019 to 2023, starting off from 0.6 in 2019, 0.56 in 2020, 0.51 in 2021, 0.49 in 2022, and lastly 0.46 in 2023. What does this indicate? This indicates that the DRB Highcom lacks the capability in paying off their short-term liabilities and expenses. As for MBM Resources, it shows a downtrending from 2019 to 2021, an uptrend in 2022, and again a downtrend in 2023. Starting off with 3.74 in 2019, 3.68 in 2020, 3.35 in 2021, 3.46 in 2022, and 3.33 in 2023. This indicates that MBM Resources has more capability than the DRB Highcom in paying off their short-term liabilities and expenses. As for the liquid ratio, again, the DRB Highcom shows a downtrend towards its last 5 years. Starting off at 0.51 in 2019, 0.42 in 2020, 0.38 in 2021, 0.35 in 2022, and 0.34 in 2023. As for MBM Resources, it shows an uptrend from 2019 to 2020, a downtrend in 2021, an uptrend in 2022, and again a downtrend in 2023. Starting off at 3.03 in 2019, 3.29 in 2020, 2.65 in 2021, 2.82 in 2022, and 2.35 in 2023. In conclusion, we can conclude that MBM Resources has higher liquidity ratio as compared to the DRB Highcom, in which the current and quick ratio is consistently higher as compared to the DRB Highcom. This means that MBM Resources has better liquidity position in paying off their most urgent debts. That's all from me. I will pass on to Yana. Thank you.
In
As you can see in our
conclusion,
chart,
the
so in
financial
2023, the RBI
comparison
Berhad
between
and
BRB High
MBM Resource
Berhad
Berhad shows significant
and
difference in
NBM
financial ratio,
Resources
with the RBI
Berhad
lower net profit margin
reveals key
2.429%
differences
compared
in
to
their
MBM Resource
financial
higher margin
performance over the period from
15.99%, while both
2019
companies
to
exhibit
2022.
relatively low return on
BRB
asset,
High
with the
Berhad
RBI
has
at
consistently
0.67%
maintained
and
a
MBM
current
Resource at
ratio close to
3.42%,
1, indicating
reflecting
that
the
it
challenge both
can meet
companies face
its
in
short-term
optimizing their asset base,
liabilities
and this
with
difference
its
can be
current
attributed
asset,
to GIB
but
Highcom
only just
diversified
while its quick
business model,
ratio has been
which include
below
high-cost
1,
competitive automotive,
suggesting
manufacturing, and service,
potential
versus
liquidity
MBM
concern
resource
as
focus on the
it
automotive
may
sector,
rely on
which
inventories
may allow for
and
better
other
cost
less
control,
liquid
operational
assets to
efficiency, and
meet
higher
its
margin product
short-term
with market
obligation.
conditions
In
such as
contrast, NBM
global supply
Resources
chain
Berhad
distribution and
exhibit
rising raw material costs
strong
affecting
liquidity
both
with
companies.
both of the current
Though
ratio and
for the
quick
NBM resource might
ratio
have a stronger pricing
consistently
power
above
and
2
difference in
and
financial
1,
practice, with the
respectively,
Highcom
signaling
potentially
a
investing in
stronger ability
long-term
to cover
innovation at the expenses of
short-term
short-term
liabilities
margin,
without
while MBM resource
needing to
likely
sell
benefit from
inventory
a
or
more
rely
streamlined
on less
operation
liquid
at the
assets.
Highcom. Higher ROA indicated more efficiency use of its largest asset base across in diverse for profitability ratio is used to measure the relative success of the firm. It's measure the profitability of a firm at a given level of asset, sales, and investment. A higher ratio is preferred as it tends to satisfy and meet the expectation for all parties involved on the firm operation. So we have a net profit margin and the return on asset. For the net profit margin, that formula is net income sales divided to 100. It is used to measure the after-tax profit per unit of sales. A higher ratio is better as indicates higher ability of the firm to obtain profit for distribution to the equity holder and internal source of financing to support normal growth. So for the return on asset, that formula is net income total asset divided to 100. It is used to measure the effectiveness of the firm to generate profit with all the available asset. The higher ratio is better.
Next, I will explain about leverage ratio. The leverage ratio is to find out the percentage or degree that the firm is using borrowed fund for their operation. Higher degree of indebtedness will result in higher risk as it indicates that the firm is subject to higher fixed payment obligations. There is two formula for leverage ratio, which is debt ratio and debt to equity ratio. Debt ratio measures a company debt as a proportion of its total assets. Formula for debt ratio is total debt divided by total assets. The debt to equity ratio measures a company's level of financial leverage. The formula for debt to equity ratio is total debt divided by equity. The debt ratio is a measure of a company's financial leverage, expressing the proportion of its financing derived from debt relative to its total assets. A higher debt ratio indicates a greater reliance on external financing, potentially increasing financial risk. The debt to equity ratio also measures a company's financial leverage, reflecting the proportion of debt financing relative to equity. DRB Highcom's debt ratio is higher than MBM Resources, indicating that DRB Highcoms relies more heavily on debt financing than MBM. DRB Highcom had its highest debt ratio in 2023 at 1.88%, while MBM never exceeded a debt ratio of 10%. Despite some improvement, DRB Highcom's debt ratios was still higher than MBM's. This suggests that DRB Highcom has taken on greater financial risk compared to MBM. DRB Highcom's debt-equity ratio is consistently higher than NBM Resources, indicating that DRB Highcom relies more on debt to finance its operations. DRB Highcom had its highest debt-equity ratio in 2023 at 451.84%, significantly surpassing NBM Resources' minimal reliance on debt. By 2023, DRB Highcom's debt-equity ratio has slightly improved, but remains notably higher than NBM Resources.
Activity ratio. What is activity ratio? Activity ratio is also known as efficiency ratio or turnover ratio. It shows if the firm uses its available assets effectively. It is also used to measure how well the firm converts receivables to cash. It is used to measure the average collection period and inventory turnover. As for ECP, it is used to determine the length of time taken by the firm to collect the debts from the creditors. As for ITO, it is used to measure the effectiveness of the firm using its inventory to generate sales. The high inventory turnover is preferred. The IB Highcom's ACP shows an uptrend between 2019 to 2020, an uptrend in 2021, and again an uptrend in 2022 and to 2023. It reached the average 159 days in 2019, 138 days in 2020, 151 days in 2021, 111 days in 2022, 98.2 days in 2023. As for Indian resources, it shows an uptrend between 2019 to 2021, and again average 22 to 2023, in which the average 22 days in 2019, 31 days in 2020, 38 days in 2021, 31 days in 2022, and 28 days in 2023. As for the ACO, the RBI shows a downtrend to between 2019 to 2020, and uptrend 2021, downtrend 2022, and uptrend 2023, in which the average had 4 times in 2019, 3 times in 2020, 3.33 times in 2021, 3.29 times in 2022, and 3.39 times in 2023. As for MBA resources, it shows an uptrend between 2019 to 2020, an uptrend in 2021, an uptrend in 2022, and again an uptrend in 2023, in which the average at 18 times in 2019, 30 times in 2020, 15 times in 2021, 18 times in 2022, and 14 times in 2023. Both companies show significant margin differences, although they are on the same industry. This indicates that the RBI operating ratio is mixed, where which its ACP is consistently higher than MBA resources, which means that the RBI require more time to collect their tax from their creditors. And its IT will be consistently lower than MBM resources, which means that the inventory cycle is lower as compared to MBM resources. MBM resources, on the other side, requires less time to collect their debts and has higher inventory turnover compared to the RBI. That's all for my part. Thank you.
In conclusion, the financial comparison between the RBI Berhad and MBM Resources Berhad reveals key differences in their financial performance over the period from 2019 to 2023. The RBI Berhad has consistently maintained a current ratio close to 1, indicating that it can meet its short-term liabilities with its current assets, but only just, while its quick ratio has been below 1, suggesting potential liquidity concern as it may rely on inventory and other less liquid assets to meet its short-term obligations. In contrast, MBM Resources Berhad exhibit strong liquidity with both of the current ratio and quick ratio consistently above 2 and 1, respectively, signaling a stronger ability to cover its short-term liabilities without needing to sell inventory or rely on less liquid assets.
So based on the comparative financial analysis, it is recommended that the RBI focus on improving its liquidity by increasing its quick ratio, reducing its reliance on inventory, and enhancing working capital management. The company should also prioritize cost control, improve operational efficiency, and refine asset utilization strategy to address its declining profitability and volatile ROA. Furthermore, the RBI should consider reducing its debt levels to lower financial risk and improve stability. In terms of operational efficiency, it should optimize inventory management to boost turnover. For MBM Resource, it is recommended that the company maintain its strong liquidity position while containing its effective cost management to sustain profitability. MBM Resource should continue its conservative approach to debt financing to preserve financial flexibility and minimize risk. Additional is it should sustain its efficiency inventory management practice and further refine them to maintain operational excellence in the competitive automotive industry. That's all for us.